Imagine you've paid your homeowner's premium on time every month for 10 years. Then a major storm hits, tearing off half your roof. You call your agent, expecting that safety net to deploy. Instead, you're hit with a massive penalty and a bill you can't afford. For generations, the deal was simple. You paid a predictable monthly fee, and in exchange, you bought peace of mind. If disaster struck, the pool of collected funds made you whole. But look at this chart tracking national home and auto insurance rates over the last 3 years. The predictable fee is gone. Across the country, rates are surging by 30 to 50% in a single year, even for policyholders with perfect records. Insurance companies point to inflation, extreme weather, and supply chain bottlenecks to explain these costs. Yet during this exact same period, major carriers are reporting multi-billion-dollar net profits. The industry is rewriting the rules of the contract to transfer the financial burden of large-scale disasters directly onto the individual. You are being asked to pay significantly more upfront for a fraction of the protection you had 5 years ago. This shift has turned the traditional safety net into a high-stakes gamble, where the simple act of using your policy can lead to long-term financial vulnerability. This starts with a change in how carriers calculate risk. They have moved away from evaluating your specific history or your immediate neighborhood, and now rely on sweeping algorithms that assess entire geographic regions simultaneously. This map shows how those algorithms spread corporate losses. If a major disaster hits the coast, the system distributes that financial hit across the entire statewide network. Millions of people are forced to absorb the costs of events happening hundreds of miles away. This functions as an algorithmic tax. Your personal record matters less than the overall profitability of the carrier's regional portfolio. Your monthly premium now serves as a mandatory subsidy for corporate miscalculations and executive bonuses, regardless of how safely you drive or how well you maintain your home. Rising premiums are only the first hurdle. A secondary, more immediate financial threat is hidden in the out-of-pocket requirements of modern renewals. Take a close look at this policy document. Carriers are phasing out the standard flat-rate deductibles we grew up with. They are replacing them with percentage-based deductibles for wind, hail, and storm damage. The math is clear. A 5% deductible on a $400,000 home requires the family to provide $20,000 cash before the carrier pays for a single shingle. You are paying high monthly fees for a policy that effectively leaves you to self-fund thousands of dollars in repairs, only providing coverage for a total catastrophic loss. Even if you can afford the premium and the deductible, you face a final penalty: the risk of being permanently dropped by your carrier for trying to use the coverage you've paid for. This dashboard illustrates how carriers use LexisNexis, a massive data broker network. Insurance companies use this database to track every minor inquiry, home inspection, and phone call you make regarding your property. In today's market, simple phone calls regarding minor damage trigger an algorithmic threshold for non-renewal. Once you are flagged and dropped, you are forced into state-backed high-risk pools that charge significantly more for less protection. The system tracks microscopic data points to abandon policyholders the moment they present a potential cost to the carrier. Navigating this market requires a change in strategy. You must stop viewing insurance as a maintenance plan and start treating it strictly as protection against catastrophic financial ruin. Step 1. Raise your deductibles to the highest allowable limit. This lowers your monthly premium. You then take those savings and place them into a high-yield emergency fund that you control. Step 2. Stop filing microclaims. Paying for minor repairs out of your own pocket is a strategic move to keep your LexisNexis record clean and prevent the carrier from flagging you for non-renewal. Step 3. Eliminate brand loyalty. Staying with the same company for a decade is now a financial penalty. Use independent brokers to shop your policy every year to force companies to compete for your business. The insurance industry relies on consumer passivity to maintain these profit margins. By taking control of your deductibles and building your own cash buffer, you break that cycle and secure your own financial defense.